Hello and welcome back to the Geordie Pig Investor channel, where we dive deep into the world of dividend investing to help you build a portfolio that pays you. Whether you're just starting out or looking to maximize your passive income, this channel is your go-to resource for strategies, insights, and the tools you need to grow wealth steadily over time. Hit that subscribe button and join me as we explore how to make your money work for you, one dividend at a time. With the market still full of uncertainty, savvy investors know that opportunities hide in plain sight, especially when it comes to dividend stocks. In today's video, we're diving into 3 high-quality UK dividend stocks that are trading at a discount right now. Whether you're looking to boost your passive income or scoop up long-term value plays, these picks could be just what your portfolio needs. If you enjoyed these 3 dividend stock to buy videos, make sure to hit that like button, and if we get over 100 likes, I'll keep the series going and bring you more stock picks every month. The first company we are looking at in today's video is BT Group, stock ticker BT.A. BT Group PLC is a major British telecoms company headquartered in London that provides a wide range of connectivity and digital services. This includes fixed line, broadband, TV, managed networks, cybersecurity and IT services to not only consumers but also businesses and the public sector. As we can see on screen, over the last month they're down 5.99% at a current price of £1.75. They're part of the communication services industry, have a market cap at 17.2 billion, when public back in 1984, have a 2-year dividend growth streak with a dividend yield that currently sits at 4.65%. When having a closer look at BT Group, we can see over on Stockopedia they have a stock rank at 68. BT Group reported strong operational momentum in its latest half year, delivering a record 2.2 million FTTP premiums, passes, and expanding its fibre footprint to 20.3 million, while Openreach added 1.1 million net fibre connections, lifting total connected premises to over 7.6 million with a take-up rate near 38%. Openreach also saw broadband ARPU rise above 4% year on year, and BT achieved 247 million in annualized cost savings as part of its ongoing transformation program. So despite a negative 3% revenue decline, BT reaffirmed its outlook, targeting 2 billion in free cash flow by FY27 and 3 billion by decade end, underscoring confidence in long-term growth. As we can see right now, the analyst consensus is a mixed bag with 4 sells, 5 holds, 5 buys and 4 strong buys, but we can see that the price target is 202 pence, which is around 15% above the current price. Hey investors, quick heads up, Snowball Analytics is running a huge 30% off Black Friday sale from November 24th to December 3rd. As a dividend investor, it's been a game changer for tracking payouts, visualizing income growth, and staying perfectly diversified. If you've been thinking about leveling up your dividend strategy, this is the best time of year to do so. Use my link below, lock in the discount, and start growing your snowball the smart way. And for my existing Snowball users, you can also get this 30% off by using my link and adding it to your current subscription. So take advantage while it lasts and level up your dividend strategy. Their 12-month Wall Street estimates have a lowest forecast around a 23% downside at 136 pence. We have the average forecast at a 17% upside, which would be 206 pence. And on the highest forecast over the next 12 months, they see BT Group valued at 327 pence, which would be an 86% upside. And when plugging in my numbers for their intrinsic value, we can see they have a 39% undervaluation, being valued at 286 pence. I think the BT Group stands out as a good opportunity this December because they offer a compelling dividend yield of around 4.6%, which is well above the UK market average and gives investors a strong income stream potential. The business is entering a favourable phase with the bulk of its capital spending behind it. The company is poised to convert more of its infrastructure investments into strong free cash flow, which underpins future dividend sustainability. And although the legacy and international operations still carry some drag, the core UK operations, especially the fibre business of its subsidiary Openreach Limited, are growing, offering better profit visibility and reducing risk for the dividend. For a UK investor seeking income in this low yield environment, BT's combination of decent yield, improving cash flow mechanics and infrastructure backed growth makes it a relatively attractive option. Next up is Hikma Pharmaceuticals, stock ticker HIK. They are a UK headquartered global pharmaceutical company that develops, manufactures and supplies a broad range of medicines across three main business segments: injectable generics, branded generics especially in the Middle East and North Africa, and generic and specialty oral products in North America, Europe and MENA. With around 29 manufacturing plants and more than 800 products in its portfolio, it aims to make high quality medicines accessible to patients across North America, MENA and Europe. As we can see on screen, over the last month they're down 7.99% at a current price of £15.95. They're part of the industrials industry, have a market cap at 2.69 billion, went public in 1986, have a 9-year dividend growth streak with a 5-year dividend growth rate at 7.59% and a current dividend yield that now sits at a very attractive 3.9%. I had a closer look at Hikma's recent earnings call and I feel the majority of it was positive. The company reported group revenue growth of 6% to around 1.66 billion, driven by strong volume gains across its key business segments and geographics. In particular, its injectables business saw revenue growth of 12% and supported by recent product launches and the contribution from the acquired Hikma Pharmaceuticals portfolio. The firm also increased its interim dividend by 12% in this period, while its core operating profit fell by about 7% due to product mix and currency headwinds. Hikma reaffirmed its full year guidance of 4-6% revenue growth and a core operating profit target of 730 to 770 million for 2025. As we can see, the analyst consensus is that it's between a buy and a strong buy right now, with 6 buys, 3 strong buys and 2 holds. And their price target is at around $30, which would be around 41% above the current price. Overall, we can see their stock rank score is at 65 and it's down 12 over these last 30 days, and that's all down to the fact that the stock has been trading down, as we can see, taking 24 points off their momentum score. When having a closer look at their 12-month Wall Street estimate, we can see that even on their lowest forecast, they believe there could be a 24% upside on the current price, on their average forecast having a 45% upside, and on their highest forecast having around a 71% upside on the current price. And when I plug in my numbers for their intrinsic value, this came out at being undervalued by 67%, with a base case valuation of 4,874 GBX, which is the equivalent of £48.74, which is quite considerably above that current price at £15.95. So I feel like Hikma Pharmaceuticals stands out as a compelling UK dividend stock for December 2025. They combine defensive healthcare stability with consistent long-term execution across essential medicines. The company benefits from diversified revenue streams through its injectables, branded generics, and generic businesses, giving it resilience against economic cycles and pricing shocks. Its strategic focus on high-demand hospital injectables and specialty products positions it in some of the most durable areas of the pharma market, while its broad global footprint, especially its dominant presence in MENA, provides steady, repeat purchase demand. Let's not forget that Hikma also has a long track record of dividend growth, supported by disciplined financial management and a healthy pipeline of new product launches, giving income-focused investors confidence that payouts are sustainable. For those seeking a stable, well-run, globally diversified healthcare company with reliable cash flow and attractive growing dividend, Hikma offers a compelling opportunity. The final stock on today's list is Greg's stock ticker GRG, and I know they featured a few months back, but with the recent drop in price, Please hear me out on this one. Greggs operates thousands of outlets across the UK, serving fresh baked goods, sandwiches, savoury pastries, salads, drinks and snacks. Greggs emphasises value, convenience and accessibility, focused on delivering freshly prepped food at competitive prices while owning much of its supply chain and investing in retail growth and digital platforms. As we can see, over this last month, they're down a whopping 16.88%, and year to date, they're now down over 50%, showing how much of a beating this stock has really taken. Their current price is £14.50. They have a market cap at 1.48 billion, when public back in 1986, have a 4-year dividend growth streak with a 5-year dividend growth rate at 7.87%, and a yield that now sits at an all-time high 4.76%. For me, Greggs is still a total powerhouse in the UK scene. Greggs surpassed 2 billion in turnover for the first time, underlying the scale of its UK food-on-the-go business. The company continues to deliver strong returns on capital. For example, its return on equity is over 27% and return on capital employed around 18.7%, a sign of efficient use of its assets. It also boasts a dividend yield that's now at an all-time high and a relatively modest payout ratio at around 48%, which supports sustainability of income for shareholders. On the flip side, like-for-like sales growth did slow somewhat and profit margins are under pressure given cost and footfall headwinds, yet for me, the underlying scale, margin resilience and dividend profile remain extremely attractive. As we can see, the analyst consensus is that it's between a buy and a hold right now, with 5 holds, 4 buys and 2 strong buys, but their overall price target is around £20, which is 39% above the current price. Greggs also has a stock rank score at 63, and recently they've had an improvement in their value score being +8, and of course, due to this massive drop over the last month, we're going to see that momentum score take a hit, and it's actually down 15 over the last 30 days. When having a closer look at their 12-month Wall Street estimates, we can see on the lowest forecast, they have a 5% downside at £13.43. On the average forecast, having a 46% upside, being valued at £20.77. And on the highest forecast, being valued at £28.03, which would be a 97% upside. And when I plugged in my numbers for their intrinsic value, on the base case scenario, they came out at being valued at £29.87, which is a 52% undervaluation on the current price. So I think that Greggs is an appealing UK dividend stock in December 2025 because it combines strong brand loyalty, nationwide scale, and a highly resilient business model centered around affordable, everyday food that remains in demand regardless of economic conditions. Its vertically integrated supply chain and efficient operations help protect margins, while continuous expansion into new locations, extended opening hours, and digital ordering channels support long-term growth. Greggs' reputation for value and convenience gives it a durable competitive edge, allowing it to consistently generate healthy cash flows that support reliable and growing dividends. For income-focused investors, Greggs offers the rare mix of defensive, steady demand and proven ability to reinvest and expand, making it a strong, stable pick in the UK consumer sector. As always, I'm 100% transparent on my channel, and if it wasn't for Greggs already being my largest individual stock holding in the portfolio, I'd be looking to increase my current position size. And that wraps up our look at 3 discounted UK dividend stocks to keep on your radar this December. BT Group stands out for investors who want a high yield, cash flow driven dividend backed by essential national infrastructure. Hikma Pharmaceuticals is the pick for anyone who prefers stability and long-term consistency, with healthcare demand staying strong no matter what the economy does. And Greggs is perfect if you want a consumer favourite that delivers steady income through a brand people buy from every single day. These are 3 very different businesses with 3 attractive yields, and each one has its own clear reason to earn a spot on a UK dividend investors watch list. If you found any value in today's picks, don't forget to like, subscribe and hit that bell notification so you never miss an opportunity to grow your portfolio. Let me know in the comments which of these stocks do you think has the most upside potential, and thanks for watching. As always, invest smart, stay patient, and I'll see you in the next one. For now, this is the Geordie Pig Investor, over and out.